let's talk about the S&P. And, markets are at all-time highs. Okay, again. And again, about 60% of the S&P total return of more than 12% for the year has been driven by 5 companies whose shares have had some of the heaviest weightings in the index: NVIDIA, Microsoft, Meta, Alphabet, Amazon. Data from the S&P Dow Jones Index showed. A look at the 10 largest stocks in the S&P 500 shows their weighting ballooned to 34.1% at the end of May, the highest ever month-end weight for the index's top 10. This exceeds the dot-com boom. This exceeds the great financial crisis. So just be aware that, we have, 10 stocks that have 34% of the weight of the S&P 500. Okay. So 490 stocks, only have, 2/3, and 10 stocks have 1/3. More than 60% of Americans in the middle class say they're struggling financially and do not expect things to turn around for the rest of their lives, according to a poll released Tuesday. The poll is commissioned by the National True Cost of Living Coalition, found that around 65% of Americans who are considered middle class, earning above 200% of the federal poverty level, are in financial struggle. The poll found that 40% of all Americans are not able to plan beyond their next paycheck. Additionally, 46% do not have $500 saved for emergency costs. I don't see that being reported too much, at CNBC. Yeah.
Mark, I got a question for you. Can you explain to me how the TLT works? Because I thought that was a T-bill, but I don't think it is.
It's a bond. It's a 30-year bond. Okay. The TLT does 20 to 30 years in length for their bonds. Okay. So when yield goes up, price goes down. When price goes up, or when yield goes down, yeah, it's an inverse relationship between yield and price. So like today, when yield went up, the price will go down in the TLT. Okay. And so that's how you'll see it. And, that's how it works.
Yeah. So like,
but it's a long-term bond. It's not what we deal with. We talk about every Tuesdays and Thursdays. We're mostly talking about T-bills, which are 30 to 60 days is what we're looking at. So the yield curve right now, David, is inverted. It's an inverted yield curve, because normally if you take out, you have a 30-year loan, you're gonna want a higher rate of interest on that because the risk is spread out over 30 years. Whereas if you're only going to lend somebody, a 30-day loan, your risk is 30 days. But we're inverted now, so we're getting 5.4% on a 30-day T-bill. They're paying us, whereas the 30-year is what? I don't even know what the 30-year is. It's probably 3, 2, something like that. Trent, I'm not looking at it right now, but it's less. So if you look at it, I think we're over 700 days that the yield curve has been inverted. And if you go back on history, every time that the yield curve uninverts, we go into a recession. So it'll be interesting to see when that does uninvert, if we continue what history has done and put us in a recession.
Yeah, the 30-year.
Where does the 5% come into play?
What is what?
If the fund goes up and down depending on the yield.
Mm-hmm. Well,
I thought it was paying like a 5% or somewhere around the 5% range, and I was wondering where that came into play.
Well, the T-bill, they have auctions. The federal government has auctions every Tuesday and Thursday, and we get to sit in, and banks and brokers bid on this. So the federal government, Janet Yellen, the Treasury Department, will come out and say, where you've got X amount of $1 billion in 30-day T-bills and 5-year Treasury bonds and 10-year Treasury bonds and 30-year Treasury bonds, and let's just say in a T-bill, we're going to offer them at 5%, and then they wait to see if there's any. It's an auction. They wait to see if there's any interest, and if there's no interest, they have to raise that up. Okay, how about 5.25%? And they may get a couple bids, and then they'll say, how about 5.4%? And then you'll see more people come in, and that's the price we get. So it's a negotiated kind of off, it's an auction, and that's where that comes from on the short term and the long term. So it's supply and demand basically.
And that's in the calculation in the TLT?
The TLT actually goes and buys 20 and 30-year bonds. So the TLT has within its, I don't know exactly how far back they go, but they have bonds coming off, on the 20 and the 30, and then they're buying more 20s and 30s on the other side. Trent, maybe you know a little more about
Yeah,
it.
so right now the dividend yield on TLT is 3.86%. If you look at, if you just went and bought a 10-year US Treasury is at 4.42%, the 30-year is at 4.543%. So that 3.86%, those are older bonds in that TLT, and as they roll off, they'll have to replace them, and so that yield could inch higher. The way to think about TLT is that instead of looking at the yield as your benchmark of the value of TLT, you're looking at the bond value itself. And as yields have gone up, think of it as teeter-totter. You and your wife are on a teeter-totter. You represent yields. She represents the value of the bond, which is issued at par at $1,000 price. You go up, she goes down. So she loses value. And when you go down, she goes up, and value the value of the bond goes up. So if you look at the last 30-year history of, say, the 30-year Treasury or US Treasury, that yield has fallen and that value has gone up until 22, I think it was. And that's where you saw the pivot, the reverse. Yields went up and value of bonds went down, which put a lot of retirees in that whole 60-40 allocation mix into G. And that's why a lot of retirees are now scrambling, going, oh, I'm not safe anymore. And it's changing the dynamics of asset allocation for retirees in a sense. So when you look at TLT, if you look at a chart today, think of just I'm looking at the value of that bond, and that bond has gone from par value, which is what it's issued at, and it's lost value. But over time, you're picking up
it's lost value because the yield has gone up.
Right. So what's the better way to play that? Well, honestly, it's to create a laddered bond portfolio of 5, 10s, and 30-year Treasury bonds. As the yields go up, you're going to pick up more yield. But when we see a rotation out of risk on assets like S&P 500 or NVIDIA or Tesla back into risk off assets like Treasuries, that yield will fall and that bond value will go up. And this is, I think, the play that you're seeing a lot of big institutional hedge funds play, is they're picking up these Treasuries at these rates. They're leveraging up anywhere from 5 to some cases probably 30 times, and they're picking up big yield numbers. And when we see a rotation out of risk on assets like equities back into risk off assets like bonds, these guys will have skyrocketing returns. And you saw that, I believe, back during the financial crisis.
Yeah, you did. That TLT price went way up.
Yeah. So you think about it, you got a $32 billion hedge fund, and you play the market of futures and bonds being the most liquid asset class in the world. You can make a ton of money. So this is where your portfolio allocation thinking is, hey, I'm buying these Treasuries, I'm picking up yield, I'm getting paid good money, especially over the last 20 years. And I'm in a position to capitalize when we do see that yield curve uninvert and bonds become the play, and you'll capitalize on that big time.
And they will invert. And then you'll see the long end of the bond, which is the 30s, their yield will go higher than the short end of the bond, which is, you know, the 1 month. And I mean, I played around with, I have an income account that just is there for income. And Paul and I talked about on the Discord having different accounts with different purposes just to kind of keep your head straight. And I've picked up a couple on auction in, you know, T-bond or Treasury bonds, 30 years, when it got over 4.5%. Okay. So I'll keep those in my income. They're paying me 4.5% over 30 years. But as Trent said, if the yield of the bond uninverts, then the yield goes down, okay, on new 30-year bonds. I'm still at 4.5%. Well, the value of my bond just went up. So you'll see the value on your account of this bond go up. And why did it go up? I mean, because you have, let's just say, 29 more years at 4.5%. Somebody's willing to buy that interest off you and pay a premium to your par, and that's what you're getting. And so a lot of people, you can see these family offices have purchased 30-year bonds when they've crossed over that 4.5%. And now, of course, when you see it fluctuate and it goes back down below 4.5%, you can see the value of your bond, okay, is now below par and it's less. You'll see it negative on your screen, but as it goes back up, you see it. The price goes up as the yield goes down. The price goes up. You'll see it. You'll gain in value on that bond.
I wanted to talk about today was I'm going to revamp the cheat sheet. I learn more. I try to learn more every week. And I got to thinking about what I'm trying to do is predict the price of a stock. And I want to predict it not for this week, next week. That I think that's a futile effort. Instead, what I want to do is predict what I think it's going to be at the end of 24, 25, 26, and 27. And I thought, well, how do you do that? And I said, okay, what makes up the price of a stock? Well, as I tried to bring it down to as small an item as I could, the price of a stock is its PE ratio multiplied times its earnings. So PE times earnings gives you the price of the stock. So, okay, so how do I find those two numbers? Well, the PE ratio, what I decided I would do would be do what they do in baseball. And that is they try to figure out what a hitter's batting average is. How do they do that? They basically look at past performance and what he's done in the past, and basically use that as a measure. Then they look at his health and his most recent efforts, weighting them towards most recent effort, and they come up with a batting average. Well, that's a PE ratio. And what in my study showed me is that much as a rookie in baseball goes through a period of building, that PE ratio varies with the time and experience that the company has had. You will find quite often that a new company has a very high PE ratio, and then as it gets more, because it isn't making money or it's not making a lot of money, but as it works out, it becomes almost predictable. So with that in mind, I said, okay, I need to study the past PE ratios of all 40 of my stocks and come up with a predictable for the next 3.5 years. So with that, then I said, okay, how do I get their future earnings? Well, they give their future earnings, most of them, I think Apple's about the only one that doesn't, on every earnings call. They give you what they think they're going to do in the next quarter, and some cases even further out into the future. And then analysts, Wall Street analysts, go in and say, okay, based on that, this is what we project it's going to be for the next 2 years. Some of them, they'll take you all the way out until 2030. So I said, okay, if I can put those two numbers together, predictable PD ratio and data supported earnings per share, I can predict the price of a stock. All right. So Trent, can I share my screen? Okay, this is what I'm building. This is, and let me get you out of my way. And let me go down here and work with, I did a video today on Tesla. Should I buy Tesla or Palantir? And then justify my decision. Well, first of all, here is the parameters that I set up as to what I want from the stocks that I want to own. And I said, I have a hypothetical portfolio of $10,000. I want stocks that are going to give me an annualized return of 33% or better. So in the first year, I will get 3,300. That raises my portfolio. And then I just do that for the next 3.5 years. That'll take me to January of 2028. Yes. So if I achieve my objective, I will have $27,290.59. That is not a 33%. That's 173%. It's not a 499. It's not 115. That's what you would kind of think. Just add those three up and add that. No, it's 173%. So that is my objective. So if I then say, okay, I'm not worried about what are they going to give me this year. I'm worried about what am I going to have on January the 1st, 2028. And I want 173% return. So I take Tesla. Do you know you could have bought Tesla for $190? Of course, they've split 2 times since then. So that brings that price down. But that's what they were selling for, split adjusted, at the end of 2011. And then, so then I go across and their PE ratio is negative all the way up till 2019. So I don't really count that. So then I come to 2020 and their price goes from $27 to $235. That's a 940 PE ratio. Well, I kind of discount that out of it. And so then I come and I average these. And that comes up to an average PE ratio of 78.5. They tell me that they are going to have earnings in 2024 of $2.55. If I might multiply that 255 times that 78.75, I come up with $177.48. That happens to be what it's selling for today. If I then say their earnings are going up to 352, I multiply at the same time. The end of next year, it'll be $76. And earnings going up to 454, 306.56. Earnings going up to 543, price is 426. I then take that number and say, okay, what does that get? What's my annualized return? Is it 173? No, it's 140. So it will not meet my expectations. Okay. So I make a decision accordingly. Let's look at Palantir. I just watched a video. Somebody sent me a video on Alex ranting about his company and how good he's doing and everything. He isn't going to outperform Tesla. He's only going to give me 100%. And again, I did the same thing. Their PE ratio is even higher than that of Tesla. It's 82 that's their average, 80, and they've only been making money for 2 years, 3 years today. So their stock will go from 23.31 to 46.80. That's a 101% return. 23 to 46, pretty easy math. Don't meet my criteria. Well, do any stocks meet my criteria? Here's one, Ultra Clean. They've been in business before 2009. They have a average PE since 2020 of 26. I took out the 48 where they had a big loss. So now I take their earnings projections. They're projecting that from 23 to 24, they're going to go from a negative 70 cents to 134 or $101.38. Next year, they're projecting 308, 530, and 720. They're going to give me a 318% annualized return. I want to own that stock. I want to weigh my portfolio a little heavier towards it. Now, will I continue to monitor the stock on a daily basis? You bet I will. But based on their projected earnings and if you add all these numbers up, that's 528% growth in their earnings from 2023. Now, they had a terrible year. They went from 88 cents to 70. What is that? I think I call that a depressed stock. I think that's called an opportunity. Here is a stock who consistently has been growing, but collapsed. Why did they collapse? Because the semiconductor industry, other than a small company by the name of NVIDIA, are not doing well. But they see their business coming back and going into a positive earnings and then surpassing all past earnings in 25, 26, and 27. So this is a stock I want to own, and I want to overweight my portfolio accordingly. Here's one that shocked me. I got to sell my Dell. I bought Dell because of Jensen telling me that he's going into partnership and building an AI factory. But what I didn't realize is that it isn't going to pay off until sometime after 2027, unless they come out with their earnings report on the next earning and adjust all these numbers up. And look what their PE ratio is. That's pathetic. And I suspect it has something to do with, if you know Dell, Michael Dell got pissed off at Carl Icahn, who was trying to take control of his company, and he took his company private somewhere back in here. And then he had to basically rebuild his company. So I'm not ready. When I did this, I didn't go and sell Dell immediately. But I got to be aware that based on what they're projecting now, they aren't going to meet my expectations. And so I got to get rid of them based on what I know now. Now, here's another one. Super Macro Computer. My God, there isn't a better stock in the world. Oh, really? Here's their earnings projections. 192% growth from 24 to 27. But their price, their PE ratio, why is that PE ratio so low? Their gross margins are pathetic. So they don't support they're overpriced right now. But here again, I multiply their 22, that's their average PE, against what they tell me their earnings are going to be. And I go from 800 to next year to 764. They're overpriced. They're right now at 769. I think somebody else figured this out other than me. They're down 20% in the last 2 weeks. Somebody else figured this out other than me. They're overpriced. Now, based on their earnings projections of $41.92, they'll end 26 at 950, and they'll end 27 at 1188. Now, would I write that in stone and put my son's life on the line for it? No. But what it's doing is telling me, how does this compare to ultrasound or ultra clean? Looks like about a 6-fold better situation. Now, this is Navitas. Navitas is an interesting company. If you haven't understood it, we were talking, Mark and Trent and I, what is the biggest problem that we are creating for ourselves right now? We don't have enough electricity available to feed the distribution centers that we're building. And Jensen is building these super computers and GPUs that use 100 times more electricity. But there's a company called Navitas who is combining another element with silicone that reduces the amount of energy needed to run Jensen's GPUs. So they're projecting from going from losing money to up to 22 cents by 2027. So my projected earnings are 1,072%. And again, this is based on their, and here again, I didn't have a real PE ratio, so I used more towards what their earnings growth. This is NVIDIA. Yeah, NVIDIA is growing, but right now it's overpriced by roughly $400 based on its own history of PE ratio. Supporting its current PE ratio, it's worth $814, but it's selling for $12.08. Now, next year, with a jump of 109% in their earnings, they'll be worth $17.02. And then with another 31% jump in their earnings, 22, and then 26. Do I want to own NVIDIA? You bet I do. But I want to buy it at $814. Now, disappointing. Again, this is waking me up to why did I buy now? Why do I think? Because now has indicated, oh no, Jensen has but this is something else I recognize. Jensen is the best salesman in the world right now. He replaced Elon Musk. He goes around. I read on his website that he was going to do a part of the appearance at Snowflake's meeting on June the 3rd. So I went to find it. He showed up video-wise. He didn't show up at the meeting. Jensen is lending his name to everybody who he has any relationship with. He is the Pope, and he is going around blessing people. So what I think I'm working at doing is taking some of this fluff out of what we're seeing. This is Micron. That's the number you want to focus on. Micron, if you don't know the difference between Micron and Intel, and Micron makes memory. Jensen needs memory because he's producing productivity, but that GPO doesn't remember what it just did. It has to have another chip attached to it. And what Jensen is doing, when we thought of chips, we used to think of a little chip about that size. Now Jensen's chips look as big as your tower of your computer. They weigh 70 pounds. They have 8 GPUs in it and 3,500 parts in it. And so he is building these, and then he puts memory chips in that chip. And Micron is his player. Micron is, I believe, out of Utah,
Idaho.
Yep. And they just got a big check from the federal government to build another foundry in New York. So this is a company you want to own. I think it's around $126 a share. Yeah, there it is right now. I've got an order in on it for about 106. If it pulls back, I think I own about 50 shares now, but this is a player. What I'm going to do is go through every one of those stocks and rebuild this. I did a video on Vertiv because Vertiv is pulling back right now. It's at $87 a share today. This is a company that makes the racks that go into the data centers that hold the super macro and Dell computers, and they have air conditioning built into them. This is a stock that kind of mirrors Modine. I haven't done this study on Modine, but they're starting to move in tandem. This and Fix. Fix has a different name, but these are people who are going to help address, or actually, they're going to help complicate the problem in data centers of using so much electricity, because the chip uses electricity, generates heat, and these people run air conditioning to help displace that heat. So Homer has written me a couple times about there is a movement or a business growing about miniature nuclear facilities. As I understand it, it will, rather than being the big nuclear plant, this will be something, if you have a data center, you will bury it adjacent to your data center, and for 10 years, you could generate at least some of your own electricity. Applied Digital, both of their facilities in North Dakota are adjacent to wind farms. So this is a real issue. This is something I'm going to look further into. But I want any questions on how this, what you're going to see in the new cheat sheet is this part right here. I'm going to give you the numbers of what I believe that price is going to be each year. And then it will be supported below by this if you choose to go into it deeper. As I compare this then to Wall Street analyst projections, and as I compare it to what I have been doing in the future, they're pretty close, except for things like this. It just opened my eyes to what does Dell have to do to get that up from 61 to 300? They either got to increase that number or they got to increase that number. They have shown no inclination. I mean, you can see their PE ratios. I don't know why they're so low, because again, they're in the same business as super macro. They're 27. Well, they're pretty close. I guess it's because their margins aren't that good. So that's what I'm doing. That's how I spend that's why I don't show up at meetings on time. Any questions or comments on this?
So let me ask you about Dell,
Mm-hmm.
because with everything moving towards an AI software platform, my computer can't handle that.
Mine
Okay.
can't.
So, and I assume yours can't, and pretty much everybody on this call can't. And as AI develops for in greater mass and becomes more used, we're all going to have to upgrade our hardware. Now, if I'm a small business, and I've got 1,000 employees and they're all have computers and they all have tablets, and I run a server system for my intranet, I'm going to have to upgrade that. So my first default company I would go to would be Dell. So wouldn't, with all this AI development, wouldn't you think though that Dell is going to see a a spending spree in the coming 12 to 24 months that would boost that return potential number up higher? I mean,
Let me
think about
ask
it.
you this.
There's nobody else who sells. I mean, HP's not a competitor.
Let me ask
Who
you
else
this.
is competitor?
Let's think this through. Why did Carl Icahn want to take the company over?
Because Carl Icahn is a catfish. He's a scavenger.
Right.
He's looking to
He's
exploit
looking
situations.
he's looking for a mismanaged company that he can go in and clean the management up and turn it into a profit machine for himself,
Or split it up.
or split it up.
That's
It's
how he
not
makes most of
efficient.
his money, is he
What
breaks
I
companies
see
up.
here is a company that is not efficient. Like you said, they are the largest producer of computers in the United States, but they aren't profitable. This is the guy that we all know who has a $500,000 a year salary, lives in a $300,000 home, and drives a Ferrari, a Mercedes, and a Lamborghini. That's Dell. It's a mismanaged company.
Explain that.
I like to think of a company is just like a household. You can make all the money in the world, but what's also important is, what are you spending? Palantir is a good example. Do you know why Palantir wasn't making any money for so long?
Because of how they paid their employees.
Exactly. They paid their employees in stock. And so they took all the profits from the top line and put it into their employees' pockets. That's what's happening at Dell. They're a mismanaged company.
Well, let me ask you this. When you compare a software company to a hardware company, the markup is way different. Hardware is way less markup,
Right.
right? So your profit margins are much smaller.
Right.
Whereas a software company, the markup can be enormous. So
the only way you pull your profits down is what Palantir did. You pay your employees. Is that required? Probably. In Palantir's case, they had to lock those engineers in so they wouldn't leave. So what they did all this time, when they were losing money, they were giving their profits to their employees. And so
okay.
they didn't make any money. I think that I look at this, there's a reason this company that has been around since probably 2000 was losing money every year. They're paying their employees too much. This looks to me like General Motors.
But here's the thing you got to consider. Since the great financial crisis up until recently, there was no need to expand your CapEx spending when it came to hardware goods. So you could run, I mean, I have a 5-year-old computer. So if and the software and the technology really hasn't evolved in the last, say, up until say 2020, right? So now you're in a phase where all this new software and technology, I mean, the three of them sat on a stage and talked about how they're building new software and technology that has to be, the equipment that runs it has to be upgraded. We haven't seen that since Microsoft, since you opted out of not buying the latest Microsoft Internet, platform. So I think, honestly, I believe you may be looking at this dip in hardware spending, and now we're just at the beginning of AI adoption and integration into, enterprise software levels. I honestly think you're going to see a lot of spending in Dell on hardware in the coming 24 months that you haven't seen in almost 20 years.
Well, I would agree, and that's why I bought it. But I'm just bringing this to everybody's attention that there's a reason this exists, and I think it's mismanagement.
I think it's because nobody's spending money on hardware. But we're in that phase again where we have to. I mean, I remember working for a software Basin modeling software company in the 90s in Boulder, and every year they were upgrading their computers because the operating systems were upgrading. And so they went from, I worked from the 3 years, and they were upgrading that hardware. I had a new computer every year, and then it stopped. So I honestly believe we're in another phase, a new chapter when it comes to hardware spending, and you're going to see that spend, and it'll come fast, especially as AI is adopted both on an enterprise level and on a individual level. I mean, I don't know. I think we just may be in that just right at the dip, right at the pivot, and it may be premature.
Would you agree with me that those two companies are in the same business?
Who?
Supermicro, which is in the blue, and Dell is in
No, Supermicro builds mega computers
for data centers.
Right. Dell builds servers and computers and hardware for businesses. Okay. So yeah, maybe they have I don't know what the percentage of data center servers is in their business, but they sell a hell of a lot more laptops, hell of a lot more servers and desktops. And how many businesses, small businesses, small business represents America.
Yeah,
that's what grows GDP. So those companies don't have a data center. I mean, I'm 2 miles away from Microsoft's data center. That's a specialty server. There are more small businesses, there's 100 times businesses versus that data center that are using hardware. And I think they're all facing the same thing that I face, and is I have to upgrade. And I'm going to be in a phase where AI is going to so fastly develop, I'm going to have to upgrade my computer every 2 years, or I can't run system. And you're going to have an explosion in hardware. So, I mean, that's my argument to it. I just think we haven't had a need to spend a lot of money on hardware in the last 20 years. And then all of a sudden, you've got this whole new phenomenon, as we saw back in the 90s with the internet and software development. So I don't know. That's my take. So I don't know. It's something to sit back and really
Yeah.
bang out the due diligence on it. But I think
Well, I
I
think it's
honestly think Dell could be a banger, a big one in over the next 12 to 24 months.
again, my only fear is it's mismanaged.
Oh, every one of those companies, that's the fear because they're having to rush into this. I mean, they're drinking from a fire hose at this point because every one of these companies is having to adopt to this ever-changing environment that we haven't seen in a long, long time. So mismanagement has to be considered with every company, even Dell. So absolutely.
Bob, what did you want to add?
No, I want to say one thing, and I know I've gone to this because I was the one that brought the tool on in. But if you take a look at institutional buying,
Yeah,
it's right in the sweet spot of the 70 to 85. So
for
what do
Dell?
those all I'm saying is, what do those institutions see? And I think they see what Trent's talking about.
Okay. So
Yeah.
Dell is in that sweet spot.
Dell
That's right.
is
We've gone from 73.5, we're up to 76.5.
Okay.
Dell
I would
Dell is
like to, I want to hear their next earnings call. I'm going to hold what I got. But I want to hear the next earnings call.
I don't that here's the thing. They are on the third row deep right now. You don't see them. But because of what's happening in the first two rows, they're being pulled forward. And Jensen and who's the now guy? Service now guy?
Uh, Bill McDermott.
Bill all said,
Yeah.
I mean, they're the two sort of they're the two who basically are going to pull Michael forward because of what they're doing so fast and the development of so fast. Michael's just gravity's going to pull him forward, you know. And so that's, I don't know, that's what's my take. And I'm like sitting here looking at it going, I've been looking at Dell computers ever since that call because I'm like, oh, they're thinking about this. Whereas HP, I don't hear anything from them. I don't know who else makes computers anymore.
Lavino.
They're an IBM division, I think, or they used to
somebody
No,
be.
it's
else.
Lenovo. Lenovo.
HP makes computers. They make more computers than Dell.
Who HP does.
They do.
So I don't know. Maybe that's another one just to consider.
I'll
But
take a look at it.
yeah, but I think that relationship between those three people is, like you said, Jensen's like waving his magic wand and christening people.
He's the Pope.
Right, until he's not. And so, anyways.
But I want you all to understand the process, and I hope you understand that the price of a stock is only made up of the PE ratio and the earnings. So there's only two variables there. And if you can focus on those two variables and have a discussion like what we are just having, you know, why is a stock behaving the way it is? And I again contend this is past history, but this tells me why Carl Icahn wanted to take the company over.
Yeah.
We have to recognize there are companies in this world that are only there to serve the executive's pocketbook. That's the only reason they're there. And I think Carl Icahn felt that was what was wrong with Dell, and that's why he tried to take it over. I know that's why I never bought any of Palantir, because I went to their earnings statement and it told me that the engineer got 75% of their salary in Palantir stock. All he was doing was locking them in, and then the stock didn't what do they call it, mature until sometime in the future. And then here in 2022, he dropped that number from 75% to 23%. And that's the first time they showed profit. So you have to understand how people run their business. This, and I guess one of the reasons, if Jensen is the best salesman currently in the world, Alex Karp is number 2. And it's, I think it's, they both have a uniform. Jensen has a leather coat, black jeans, black shoes with white rims. Alex has a crazy hairdo and a t-shirt. And they're both salesmen. Don't get sold on something you don't understand. Again, look how meager their earnings are.
Yeah.
They're keeping the money for themselves.
I've been on this road trip for a week and a half, driving across the United States. And, it's, first of all, if you ever want to disappear, go to South Dakota. Nobody will ever find you. But I think what I'm seeing
But
is,
you'll lead a miserable life.
well, it's just, you won't talk to anybody, that's for sure. But I think what I'm seeing is, there's this big push into the very small segment of the stock market. And it's because those guys are very public, Jensen Huang and, Elon Musk and all those kind of guys. I look at this and I go, the headwind in all this is energy. We talked about it earlier. How much more energy can we create based on the actual electric grid we have? I drove through parts where I didn't have cell phone connection for an hour. And I can't believe in this day and age, I still have that problem. So I don't know, I think AI is the future. I just wonder, where it is in the short term, I guess that's my concern.
If you don't have the energy, then how in the heck are you going to do AI?
Yeah.
That's what it comes down to. And by the way, do we really have fossil fuels? Are we behind schedule? I think we're behind schedule. I think you're going to see fossil fuels go up. By the way, we've already talked about electric vehicles. Their time, they came out too soon. You don't have an infrastructure to support them. And I think this is going to be a similar problem with AI.
Yeah.
And energy. Energy is the bottom line.
I think you look at our electric grid in the United States, don't take the rest of the world out. And we all have seen it over the last 10 years, the strain on our electric grid. We've seen it in California. We've seen it throughout. And I think until we address our electrical grid in the United States and the infrastructure build out in it, there's only so much we can pull from it. I was telling Kerry and Mark, I'm in Cheyenne and I'm about 2 miles from a Microsoft data center. And the only purpose of that data center is to provide, I guess, what are processing data for one Microsoft shooter game. One. And their contract with Cheyenne, is the people I'm staying with told me, was they went to the government of Cheyenne, said, we'll pay out the wazoo, but we are first on electricity. If the electricity goes out, we are taken care of first. Everybody else waits. So what it tells me is, if that happens here, the people of Cheyenne could be in a blackout for a while. But that Microsoft data center will continue to run pretty hard. So I look at it and I think we're coming, maybe not in the next 2 years, but in the next 3, we could be running up against a electrical grid challenge at this point. Especially as more and more we get on electric driven devices, you know. Kerry mentioned something about the portable nuclear power project. The biggest, in my opinion, the biggest challenge is the word nuclear. It's just such voodoo in a sense in this country. It's efficient, it works. How do you dispose of nuclear waste? I don't know yet, but I think those are other areas to consider is power. How are we going to power all this AI and EV development?